Welcome to the Lord Abbett 2020 Investment Outlook. My name is Tim Paulson, investment strategist at Lord Abbett. I'm joined with some of our leading investment professionals.
My name is Kyu-Jin Ya. I'm a fixed income portfolio manager.
Tom O'Halloran, portfolio manager of the Innovation Growth Strategies.
My name is Tim Paulson, investment strategist at Lord Abbett.
Hello, my name is Dan Salander, director of tax-free fixed income.
Hi, I'm Leah Traub, a portfolio manager in taxable fixed income.
I'm Giulio Martini, director of global asset allocation and manager of the multi-asset portfolios.
We'll be talking about markets today, what's gotten us to this point, what we think that means for the coming year, and key risks to those views that we'll be looking out for. So, to get things started, 2019 surprised an awful lot of investors. We came into the year with incredible risk-off sentiment to end December, really record outflows for mutual funds, followed by a very sharp reversal, led by the Fed apparently in 2019, and it continued more or less throughout the year. Some fits and starts, but recently reaching all-time highs in the S&P 500, and interestingly, very low interest rates. So just circling back, and of course there's a lot of negative news, some positives, we're gonna talk about all of this, but as maybe a way to get into this, we can just reference our mid-year outlook, where unlike most folks out there away from us, we had a fairly bullish view of risk assets. We also had a view that Fed cuts were not necessary and therefore probably not gonna happen. We certainly got the first one right, maybe not so much on the Fed. Let's talk a little bit about what we saw that maybe the rest of the world wasn't seeing, and then what we learned from the Fed. Maybe Giulio, if you could start us off.
I definitely learned something about the Fed this year that's very new, and I think it comes out of some new research that the Fed has done and a new approach to monetary policy when short-term rates are so close to zero. The Fed was willing to cut rates aggressively sooner than it usually is. Usually what's important to the Fed is its dual mandate, that it be achieving maximum employment with inflation close to 2%, which is its target. And the Fed is very close to achieving that dual mandate. But despite that, they were willing to cut rates because the threat from tariffs and potentially a growing global trade war could slow down economic growth enough to take them away from those targets. And what they were willing to do was cut rates much sooner, because what they've come to believe is when rates are so close to zero, it's important to act early, and that the cost of being wrong if you act early and it turns out not to be necessary is much greater than the cost of being wrong if you don't act early and you end up having rates fall essentially to zero, which is where monetary policy becomes much less effective. So that was a surprise to me. I think it's a change in their outlook of how they're going to manage policy. And it's something that I think the markets have clearly benefited from, is an orientation to really reduce risk when it manifests itself in this situation.
One thing that we did get right that when we talked about it was the better outlook for global growth and for the US growth, right? I think a lot of the sentiment in the market in the third quarter became very negative, right? That we're definitely in a recession. And we did not buy into that. And it was really because we're looking at all the different indicators in the economy, not just in the manufacturing area. So the manufacturing area certainly was hurt by the trade tensions globally and in the US, but the consumer has been super strong and the consumer confidence has held up. And we have not seen a spillover yet from the manufacturing slowdown to the rest of the economy. And that was one reason why I think we were a little bit more bullish on the US kind of throughout the summer, and that we remain more constructive because the U.S. economy is more obviously driven by consumption than it is by manufacturing, and I think becoming too focused on just a manufacturing index sentiment or something like that can lead you astray sometimes.
A few times that we've been doing this, we've been talking about what the market's construing as the potential end of cycle, right? Whether it be an inverted yield curve or just global growth slowdown, and that's what I agree. That's exactly what we've been pushing back on and saying this expansion doesn't have to end, right? Giulio said it so many times in the sense that this expansion can keep going.
So I just want to pick up on the recession idea, because I do think, since we're in the longest US economic expansion ever, 124 months and counting, that everybody's kind of suffering from a collective case of end of cycleitis. In other words, that this has to end sometime soon, and is looking for a reason for it to end. But when you examine recessions, they end typically because the economy develops excesses, either excess demand that manifests itself in accelerating inflation, and we don't have that problem at the moment, or excesses in financial markets, which manifest themselves in valuations that are exaggerated or excessive leverage. And we don't have those problems at the moment either. And another cause of past recession, or at least a contributing factor, spikes in oil prices, which have really been implicated in every US recession since the mid-1970s, also are not a problem. So there really isn't a cause that would make you think there will be a recession anytime soon, despite the fact that we've been growing for so long. And in fact, I don't believe we're going to have a recession in 2020. And if we have one in 2021, the dynamic that's going to lead to it has yet to develop, really.